Deciding on the type of mortgage isn't the only choice on the path to your dream home. Nearly all loans, VA loans included, let borrowers choose either a fixed rate or an adjustable rate mortgage term. A fixed rate mortgage is exactly that. You'll have the same interest rate for the life of the loan, unless, of course, you decide to refinance down the road. That fixed rate provides a great deal of certainty and security for many buyers. An adjustable rate mortgage will typically start with a lower interest rate than what you'd find on fixed rate loans. And that lower rate at the outset can mean more money in your pocket. It can even help you qualify for a bigger loan. The rate on an ARM is subject to change depending on a host of different factors, and the risk of ARMs is really rooted in their uncertainty. Now, a traditional straightforward ARM typically comes with a low interest rate at the outset, and it can change on a yearly basis. That change is known as an adjustment, and it's tied to different economic indices that are out there, typically the 1, 3, and 5-year securities. In addition, lenders can tack on one or more percentage points, and that's known as the margin. So on these traditional ARMs, these adjustable rate mortgages, your rate can be the sum of the index rate and the lender's margin. There's a more specialized loan product out there. It's called a hybrid ARM, and that's become increasingly popular in recent years. These have a fixed interest rate for a certain period of time before they can begin to adjust or change on an annual basis. So, for an example, a 5-1 hybrid ARM that's become popular features a fixed interest rate for the first 5 years of the loan. And then after that, it can adjust on an annual basis. It can go up or down, above or below that initial 5-year rate. Now that gives you a fixed 5-year period that helps borrowers really have certainty when it comes to their monthly mortgage payment. Adjustable rate mortgages with government-backed programs like VA loans can also offer buyers protections beyond that. A VA ARM features a mandated 115 cap. And here's what that means. The highest that your rate can adjust on that first adjustment is 1%. So you could have the same rate for the first 5 years, and with this cap, the most it could go up that first time is just 1%. After that, this is the second one, after that, each year, the most it could go up again is 1%. And that 5 is over the life of the loan. If it's 15 years or 30 years, the rate can't go up more than 5 percentage points over that initial rate that you started with. So you've got info on fixed rate, you've got info on adjustable rate, and the question is, how do you decide between the two? A lot of it really has to do with your short-term and your long-term goals. So if you're only planning to live in a home for a few years, you might want to explore an ARM in greater detail. Buyers who are more likely to stay in their home for a longer period of time might want to stick with a fixed rate option. Of course, the reality is it's impossible to know what the future holds. So new jobs, new duty stations, and other events, all these things can impact your living situation, can impact your mortgage. So take a hard look at your finances and both your short-term and your long-term goals before choosing your mortgage term option. Talk with a loan officer about the pros and cons of both fixed and adjustable rate loans.